Now that you've seen the past history of stock returns, you have to ask yourself, what the heck does any of this mean? What can we determine from all this stuff that we've looked at? Looking at a dollar that's increased in value from 1926 and then comparing it to increasing in value from the 1800s. What does this information exactly tell us? Two things stand out. First is the risk-free rate. This is the rate of return on a riskless, certain investment. A riskless, certain investment is an investment where we put our money into it and we get it out completely, absolutely guaranteed. There was only one chart that showed us that possibility, and that was the chart of T-bills. T-bills are risk-free investments. All of the other investments sometimes kicked out a negative return. In other words, we didn't always get our investment completely back out of any of the other different selections. All of those other different selections have a risk premium associated with them. That's the extra return on a risky asset over the risk-free rate. In other words, this is the reward for bearing risk for putting your money in anything except Treasury bills. The first lesson here is that there's a reward on average for bearing risk, but it's critically and vitally important to understand that that reward is absolutely not guaranteed. And in fact, when we take a look at large stocks, we see that the average return was 12.2%. The risk premium was 8.4%. When we take a look at small stocks, the average return was 16.9%, and the risk premium was 13.1%. When we take a look at corporate bonds, the average return was 6.2%. The risk premium was 2.4%. Long-term government bonds had an average return of 5.8%. The risk premium in this case was 2.0%. When we take a look at U.S. Treasury bills, these are our risk-free investments. The average return was 3.8%. And the risk premium was 0 because this is the riskless investment. Many financial researchers ask the question, why does a risk premium exist in the first place? And modern investment theory centers on this question. It turns out that there's a yin and yang of the investment scenario, and that is that high possible risk of loss is inextricably paired with a high possible reward and gain.